Hey everybody, this is Alex Merced, and you're listening to Economics and Finance for Noobs. And, now that it's been about like 24, 48 hours since the announcement of the failing of Silicon Valley Bank, I thought I would just kind of like explain the high level of what is going on for those who may want that. Bottom line is, what happened with Silicon Valley Bank is that they have a liquidity problem, meaning they just don't have the cash to meet their obligations. Does this mean they're short on assets? Does this mean that the customer's money has disappeared? Not necessarily. Again, a lot of these words are much more complicated. Okay, so for example, imagine that I have $1 million house. Okay, and if I took all my liabilities, all the money that I owe, it adds up to about $500,000. Let's just say that. So theoretically, what I have is what's called $500,000 of equity. If I took that house, sold it for $1 million, paid off the $500,000 of liability, I'd have $500,000 of equity, also known as net worth. So that's my net worth. Problem is, I cannot pay my bills with house. I cannot grab a piece of the drywall and mail it into my Spectrum to pay my cable bill. Okay, so theoretically, I have this thing that is worth $1 million. Doesn't necessarily mean I actually have $1 million in cash to be used to pay him off a lot of these obligations. Okay, and if that's all I had no cash, all I had is a house, then I would have a liquidity problem, because the only way for me to have cash would be to sell the house. And if I'm selling the house under pressure, like if I'm selling it I really need to sell it right away to get this cash right away, chances are I'm not going to be able to sell it for the full $1 million, because I'm going to be in too much of a rush to sell it. So buyers will smell the fear and lowball me, and who knows, maybe you get like $600,000, you pay your $500,000 of liability, and you really walk away with $100,000 in cash. And that's still like, hey, a happy scenario. So that's what a liquidity problem is. It's not necessarily that you don't have value. You don't necessarily have, it's not that you've lost the wealth you need to do the things you want to do. It's just that the form that wealth takes is in isn't what you need to keep things going. Okay, so in the case of Silicon Valley Bank, they would take money from depositors, and that money would generally be stored in safe assets. Okay, so this is not like they were investing in like risky assets. None of this stuff like from like 2008 with like the CDOs and the CMOs, using low quality mortgages. These were high quality assets in the form of government bonds. Okay, now regardless of how you feel about the government controls the money supply, so there's not really a question whether the government will pay you back the $1,000 or $100 per bond in your investment. Okay, you're definitely going to get that money when it comes due. Okay, so and these loans can be like 1 year, 2 years, 3 years, 5 years, 10 years, 30 years. Okay, when you lend money to the government. But a lot of the bonds that they purchased were before a lot of the recent rates of interest had gone up. So essentially, imagine this: you have a bunch of bonds that you bought, so you have a bunch of loans that you've made for 1%. Okay, and basically every bond is like a piece of a loan. So you essentially, let's say the government borrows $1 billion, you buy $1,000 bond, you're essentially a lender of $1,000 of that loan, and you're going to get back interest on top of that. So you have this 1% piece of loan. Now, a year later, interest rates have gone up, and now basically all the new loans the government's taking out is, let's say, at 5%. Okay, so now there's all these 5% $1,000 pieces floating around. So as an investor who doesn't own a bond, what would I rather buy? The new bonds being issued at 5%, okay, or your old bond at 1%. Okay, either way, it's going to pay me $1,000 at the end. Okay, it's just the difference will be how much interest I get in the meantime. Do I get 1% interest or do I get 5% interest? Well, if you guessed that I would prefer to get 5%, then you are correct. So what's going to happen is that your 1% bond, if you wanted to resell it, like if you wanted to wait till the loan ends and get your $1,000 back at the end, you can do that. But what if you need to sell it because you need cash? Well, now you're not going to be able to sell it for the same value that it was when you bought it. So that $1,000 bond may be like now 900, 800. Okay? So what happened is with the increase of interest rates, okay, this presented what's a risk called interest rate risk. So this is the risk that rates go up and the value of your bond goes down. Basically hit the portfolio of Silicon Valley Bank pretty hard. So the idea is they still had, let's say, $1 billion worth of bonds to back $1 billion worth of deposits. Problem is, when people withdraw money from their bank accounts, they're not withdrawing bond, they're withdrawing cash. So theoretically, like Silicon Valley would need to sell these bonds to have the cash for people to withdraw their money. And the problem is if these bonds have lost value, well, now technically their resale value won't cover all the demands for cash. Okay, that's essentially what happened. Okay, so it will show you, even when you make the safest investments possible, okay, there's still risk. And this has happened before in the 80s, where people like loaded up on bonds, interest rates went up, bond prices go down, it has all sorts of ramifications on bond portfolios and whatnot. So essentially that's what happens. Okay, so basically the resale value of all these bonds basically could not keep up with the cash needs of the bank. Okay, they didn't invest the money in anything risky, they didn't do anything necessarily shady, they just didn't manage their interest rate risk. Okay, I don't know if they tried to engage in any kind of interest rate swaps or credit default swaps to manage that risk. Although credit default swaps wouldn't have helped here because that's only if the issuer defaults, so that really wouldn't have made a difference here. Yeah, there wasn't anything to really sort of like mitigate that risk, so the bank just had to be closed. And generally that'll all be resolved fine. You hear a bank fails and you hear about FDIC covered up to 250,000. But the thing is that the money's not necessarily gone; it's just tied up in assets. So essentially what's just going to happen, typically happens, is that someone's going to buy that bank. So someone's going to take on the assets and liabilities of that bank, which means they're going to take on all those bonds, but they're also going to take on all those liabilities. And if that institution, whoever takes on those liabilities, they're going to get all those assets, but if they also have a strong liquid position, so they do have a lot of cash on hand, then they can, basically everything just continues running like normal. Okay, more than likely, when the dust settles, you just basically have a bunch of customers who move from one bank to another. The other bank has a much stronger cash position, so those bonds can then ride out to maturity, and the cash position of that bank can then handle all the withdrawals and stuff like that. Okay, so that's generally going to be sort of like the first ring of defense for like the FDIC. If FDIC gets involved, they're going to be like, okay, well, we have this bank has failed, it's dead, but it still has assets and it still has liabilities, and we need another bank to take on those assets and liabilities. And really, you just need a bank that's liquid enough to be able to handle, to take on the illiquid assets and be able to wait them out, yet still have enough cash on hand to kind of continue moving forward with those liabilities. Basically handle people's withdrawals. Absent that, for some reason there's a shortfall of that, that's where like the $250,000 of coverage goes from FDIC, and if for some reason that isn't enough, especially like businesses and other bigger figures, they generally oftentimes will have additional insurance. Okay, so like, will everyone be made whole? Yes, more than likely. The damage is in the perception. Okay, so you're gonna see several things will kind of come out of this. One, you're gonna have a lot of people just worried about banks in general, and they're gonna be pulling their money out of all banks, okay, regardless of the reality of whether their bank is fine or not. And the problem is, if people pull out their cash, which means they're gonna zap other banks' liquidity out, well then that can create the same problem in other banks that were perfectly healthy on Friday. They were perfectly healthy, but because everyone pulled their money out on Monday, now those banks are unhealthy. So it creates a sort of contagion effect. Okay. On top of that, basically there might be a sell-off of some of these assets to provide some liquidity for these withdrawals. Okay, so that can so if everyone's selling something at the same time, that can cause prices to go down. And when bond prices go down, interest rates go up. So there might be an interest rate spike in the very, very short run. Okay, as people respond to this. Okay, so again, it's going to happen, one, because bond prices are going to go down if there's a sell-off. And two, is also going to happen is you're going to have a huge demand for cash because all these customers of Silicon Valley Bank still need liquidity. They're businesses, mostly startups, that need cash to make payroll and things like that. Generally, oftentimes they may not actually even have like all their money tied up in a traditional savings or checking account. They may actually have a lot of that money, that startup money, sitting in their own government bonds, and they need an institution who's going to lend them against their own bonds to provide them liquidity. And if SVB is not doing it, they need another institution. So you're gonna have all these like startup type institutions going around to other banks saying, hey, are you willing to lend us money against our assets so we can continue operating? And that's going to cause a real surge of demand, which will increase the cost to borrow money, aka interest rates. Okay, and so you'll have a push on interest rates, one from the sell off of existing assets liquidity needs, and from the demand for liquidity occurring at the retail level. So it can be very bad. Okay, and basically what happens is interest rates go up. Okay, that can end up making bond investments seem more appetizing, which drives money out of the stock market. So you can see a sell-off. Also, again, generally interest rates go up when people when there's uncertainty in the economy, and that also just basically drives stock prices going down. So Monday should prove to be an interesting day, not a pleasant day in the market. Again, while Silicon Valley Bank is a unique bank with a unique clientele base, what went wrong is not something particularly unique in the sense that it's not unique to the particular customers it had. Banks bought, investor money and assets. Interest basically, and generally most banks, when they want to put their money somewhere safe, they put it in government bonds. Interest rates have gone up. So depending on how different banks have managed their interest rate risk, this could be a sign of sort of a larger, I don't want to say a government bond bubble because people throw that term like loosely, but I mean, you did have a huge amount of government debt issued at very low interest rates not that long ago. Okay, and now with interest rates going up, you're seeing a drop in the value, and a lot of that debt is used, generally as a place to kind of store safe cash. And well, if its value is dropping, you're essentially like causing sort of like a crunch of liquidity because all that existing debt cannot be sold for its principal value, which is generally kind of one of the things you kind of hope when you buy government debt. So this may be a canary in the coal mine. We'll find out. I mean, tomorrow should be again an interesting day. But hopefully this helps you understand the situation a little bit better. Again, if you're a customer of Silicon Valley Bank, whatnot, again, probably not a huge issue in the short run. Kind of thing where it just causes some like late vendor payments and some late payroll payments, which suck, and can definitely cause other cultural issues, but not the larger systemic risk is going to be how the rest of financial actors respond to this, as far as like stock sell-offs, withdrawals from other banks, things like that, to see kind of how much the fear that this will trigger. Because again, one bank falling apart causes this ripple effect because now everyone assumes that banks are just banks and they will always be banks. When one goes out, it makes everyone start second guessing their financial institutions, and then that's where things start getting really, really, really sketchy. So hopefully you guys enjoy this. I'll see you all later. Again, this is Alex Merced. You can follow me on Twitter at Alex Merced. Have a great day and enjoy.